Welcome back to another episode of We Are Talking Money. I'm Dustin Hawken. Most people think that life insurance death benefit is tax-free. Well, that's only partly true. Life insurance death benefit is income tax-free, but it's not always estate tax-free. And that can be extremely costly, as estate taxes can be up to 40%. Today, we're going to be talking about a strategy that helps make sure that your life insurance isn't taxed. Before I begin, please give this video a like and be sure to subscribe to our YouTube channel. It really helps us continue to grow our reach. We put out new videos every week on interesting and relevant financial planning topics, so it'll help you make better financial decisions as well. Just click on the subscribe button below. Today, we're going to be talking about a strategy that involves 2 of the 10 wealth management elements: risk management and estate planning. These elements are focused on 2 things. First, making sure all the what-ifs in your plan are covered. Second, making sure all of your assets pass as efficiently as possible. This is why comprehensive planning is so important. Most of these strategies involve more than one element, and you want to be sure they're all coordinated because actions in one element generally affect another. Life insurance can be an incredible financial planning tool, but if you've built up enough wealth, your life insurance death benefit might only be worth about half to your beneficiaries. Estate taxes are something that a lot of our clients need to plan for, and you might need to as well. Estate taxes kick in when there's an estate over $12.92 million for an individual and $25.84 million for a married couple in the year 2023. Any dollar amount above these limits is subject to an additional transfer tax called estate tax. The estate tax rate is anywhere from 18% to 40%, with any dollars above $1 million being taxed at the highest 40% rate. When estate taxes are due, beneficiaries have 9 months to pay the estate tax. This can be a big ask if you have millions of dollars of estate tax. What can you even do in this situation? Well, let me introduce you to an irrevocable life insurance trust. Picture this. You have an estate tax due of about $2 million, and your parents, who just passed away, owned a very successful business or a lot of property that you don't want to sell. Well, how are you going to pay the estate tax? Well, what if $2 million of tax-free cash was just deposited into your account? This is exactly what can happen if you plan properly. Let's talk about how to set this up. If your goal is to pay estate taxes, you'll want to get a permanent life insurance policy, one that won't expire before you or your spouse do. Most types of permanent policies will work, but the most inexpensive option is what's called a second to die policy. This is the type that we normally recommend. After all, if we need to buy insurance, we might as well pay as little as possible, right? Be careful here. Some advisors will sell you a different type of product that costs more, therefore pays a higher commission. A second to die life insurance policy is normally the way to go because it's insuring the lives of 2 people, therefore cutting down the cost. The insurance company doesn't have to pay a death benefit on the death of the first spouse. They pay the death of the second spouse. Therefore, they can price the plan accordingly. This is also the go-to strategy if one of the spouses have any health issues, as second to die coverage is generally easier to get through underwriting. Once you're approved for the insurance, the next step is creating the Irrevocable Life Insurance Trust, or ILIT. The ILIT is the tool that gets the insurance out of your estate. You'll want to work with an attorney to be sure all the language is crafted properly. If you need an estate planning attorney, please reach out to us here at OmniStar. We have plenty of alliance partners who have done this exact strategy for many of our clients. Once we have the ILIT set up properly, the trust will be named the owner and the beneficiary of the second to die insurance policy. Now we need to pay for the policy, so how are we going to do this? Well, because this is an estate planning technique, we're going to be gifting the premiums to the trust. Based on the current rules for grantors, or the insureds in this case, you can give up to $17,000 per spouse, per beneficiary, per year. So what that means is if you have 2 beneficiaries or 2 children, you can actually give up to $68,000 of premium to the ILIT without having to use any of your gift tax exemption. The last step that we don't want to miss is completing a crummy letter to each beneficiary of the trust. The crummy letter lets the beneficiary know that a gift has been made to the trust, and they usually have a certain amount of time where they can actually withdraw the money, usually 30 days. After the 30 days, the gift is used to pay the life insurance premium. This may seem strange, but we need to do this to change the premiums from a future gift to a present gift by giving them access to the premiums. This allows us to use that $17,000 per spouse, per beneficiary, per year gift tax exemption. Having a family meeting to discuss the strategy is extremely important so your beneficiaries know not to withdraw any of the cash. If they withdraw the cash, there won't be any money there to pay the premium on the life insurance. Policy will lapse, and therefore there won't be any of that tax-free money to pay the estate taxes in the future. Having family meetings are important because you want to make sure everyone's on the same page and everyone knows the strategy. The more educated and in tune the family can be, the more likely it is that the strategy will be successful long term. I know there's a lot of steps and this can be confusing, so if you think that you might need to implement a strategy like this, please don't hesitate to reach out to us at OmniStar and we can help guide you in the right direction and put together the correct team. It's also important to note that wealth doubles every 7 to 10 years on average. So if you're 60 years old today and you're worth $5 million, it's likely you might have some estate taxes due in the future. And if you don't plan properly, most likely your beneficiaries are gonna get hit with a lot of tax. If you liked today's video, please like the video and please subscribe to our channel right now. We appreciate it. It helps our channel and helps you stay better informed. Just click on the subscribe button below. You can also follow us on Facebook, Instagram, and LinkedIn, and of course our website, www.omnistarfinancial.com. Thanks for watching, and we'll see you next time on We're Talking Money.
Thanks for joining us on We're Talking Money. Be sure to visit us at omnistarfinancial.com, where you can learn more about how we provide value to our clients. Subscribe to the show and our newsletters, and drop us a line with topic suggestions for upcoming shows. If you enjoyed the show, we would appreciate you passing it on to a friend and providing a rating on iTunes. This podcast is a publication of OmniStar Financial Group. The content is developed from sources believed to be reliable and accurate with all information. The information in this material is not intended as tax or legal advice and may not be used for the purpose of avoiding any federal tax penalties. Please consult legal or tax professionals for specific information regarding your individual situation. The opinions expressed and material provided are for general information and should not be considered a solicitation for the purchase or sale of any security or service provided by OmniStar. All expressions of opinion reflect that of the authors and are subject to change. Any distribution, use, or copying of this podcast, other than the intended recipients, is prohibited.